My name is Javier Taylor. I'm a member of Group 7, and my partner is Christina Swathsmary Kearley Hagee. And we are interested in the price of gold, especially in modeling the price of gold. The reason for this interest is that gold is an interesting investment. A lot of people use gold as a safe investment. So whenever there's economic turmoil or there's trouble in the world, gold is seen as a safe investment. So is this a reasonable investment? Is it reasonable to think that the price of gold is safe? So you see here a plot, a time series plot from January 1968 to July of 2020. So 52 years and 7 months worth of data. And you can see right around 1980, there was some volatility in the market. The price spiked. You can also see a similar volatility right around 2011, 2012. And we are currently experiencing higher gold prices. The price today was $1,840.70 per ounce. So will that trend continue? So these are questions that time series analysis can allow us to answer. So the first thing we did was decompose the data. So you see the top there, the observed data we saw in the previous slide. The trend there, you can see that generally there's an increasing trend. It doesn't really look linear. So doesn't appear to be a seasonality in this. And you can see there is some noise in the data set, and especially right around the 80s, there's noise there in the 70s, right whenever gold started trading in the United States, about 1975, I think. And since then, you can see there's been a pretty standard amount of noise in our data set. So we decided there which would be the transformation that we'd want to use. So we tried log transformation and we tried differencing. So just the first difference allowed us to have a stationary data set because our current data set, our original data set, is not stationary. So we found after the first difference, our data set was stationary. We used a Dickey-Fuller and Phillips-Perron unit test. So at first it was not stationary, it looked more like a random walk. But after our first difference, we had very low p-values for Dickey-Fuller and for Phillips-Perron. So after the first difference, there's not likely to be a unit root on there. So there might still be some correlation between lags 1, 5, and 11. So that'll be something to have in mind. The log transform seems to be the one to go with. It has really good p-values in Phillips-Perron and Dickey-Fuller. And we have stationarity after taking one difference. We do have some volatility around 1980, but the log difference is really supported by also the QQ plot. So we think like we have a model there that works. You can see that the difference of log there looks fairly good, looks stationary. So we feel like that's the method to use. The transformation is a difference, a log difference. So that's where we're going to get our models from. So based on this, we looked at the best candidate models, and the MA1 and AR2 were the ones that seemed to be best as far as our PACF and our ACF, since the ACF cuts off after lag 1 and the PACF after lag 2. We looked at the MA1 and the AR2 models as candidate models. Based on the ARMA subplots, we looked at the MA4 model and the ARMA 11.4 model. You can see the MA1 has the best BIC at 2101.93. So if you want the best model, probably MA1 is that one. For forecasting, we really choose a model with the best AIC, AICC. And if you look down, that is the ARMA 11.4 model. So we did a young box test to see if that was going to be a good model to choose. We also did an analysis of the QQ plot for that model. So the QQ plot looks very linear. Also, the lung box test is greater than 0.05, so we cannot reject the null. So the 11.4 model seems to be the one that is going to give us our best forecast output. And you can see over the next 4 years, the forecast is that the model continues to rise. Now it's an interesting rise, and you can see that the further out you go, of course, the bounds of the bounds of the model, the confidence bounds are going to grow very greatly, but it looks to be growing sort of in a log fashion there. So it looks like at least over the next 4 years, gold is a safe investment if we're forecasting our model here. It seems to be the right one. So in conclusion, we would say that the data seems to support the investment in gold as a safe haven investment, and that gold will continue to increase in price, at least in the immediate future, within the confidence bounds of our model, which is the ARMA 11.4 model.